All right, so that said, this is Coffee with Your Retirement Coach. And so for those of you I haven't met, my name is Nick Yeomans, and I'm going to be one of the speakers today, and then Randy Yeomans, he'll come up here shortly. But I thought we'd kick it off some basic, understandings around total wealth today. So we're going to talk taxes, we're going to talk portfolios, we're going to talk a little bit about real estate, and we're going to have a Q&A at the end, so please, if you do have any questions as we're going through this material, make sure you jot your questions down because we want to make sure we give adequate time to everybody at the end. All right. I don't know about you guys, but the US dollar and tariffs. Any of you guys been thinking about that, hearing about that? I mean, my gosh, right? In a few minutes, Randy and I are actually going to debate whether or not tariffs are good or bad. All right, so that's coming. Ooh. Everybody's excited. I know. I am too. So let's talk about the US dollar first. So over 2024, the dollar's uptrend was underscored by America's economic dynamism. All right, I can spell it better than I can say it. While Europe and China face muted GDP growth, bottom line is we looked a whole lot stronger because some of our biggest competitors as other nations, they were slumming last year. They were really slouching, especially noted in Europe and China. Second, first, tariffs could rekindle inflation. We are concerned about that. Tariffs are, by nature and definition, inflationary. And I don't know about you guys, but the last 3 years, I've had about enough of inflation. What about y'all? Right? Second, tariffs could cause economic weakness in other countries, improving America's relative strength, creating higher demand for currency. However, tariffs run the risk of dampening the U.S. economy, which could weigh on the dollar. And it's kind of interesting, the last point here talks about Trump's position on the dollar being contradictory. It's like, do we really want a strong dollar? It makes us feel good, as a citizen, as a patriot, like a good, strong U.S. dollar. But on the flip side of that coin, it can make us a little less competitive. What's right, what's wrong? I don't know. That's above my pay grade, but it is interesting to at least ponder it. Now, I'm going to go ahead and welcome up Randy. We're going to have a little bit of fun. We thought we'd do, it's almost a little good cop, bad cop. We'll let you guys see who's the victor here. Randy's coming under the notion of tariffs are a bad thing. I'm going to make the argument that tariffs are actually good. Y'all ready? All right, and then at the end we'll do applause and find out.
Hold on. Nick, tariffs are bad. They're always bad. They mean higher prices for consumers. Tariffs act as a tax on imported goods, increasing the cost for businesses and for consumers. This leads to higher prices and more inflation.
I'm going to say that tariffs are good. All right, so how about this? Protects domestic industries. Tariffs make imported goods more expensive, helping U.S. businesses compete against cheaper foreign products.
Regulatory tariffs hurt the U.S. exports. Other countries often respond with their own tariffs, making it harder for American farmers, manufacturers, businesses to sell goods overseas.
How about this? I think that tariffs encourage domestic manufacturing. I like manufacturing here, okay? Higher import costs push companies to produce goods in the U.S., creating jobs and reducing reliance on foreign supply chain. Case in point, Apple's record-breaking $500 billion commitment here in the United States.
Those are inflated dollars. They harm U.S. businesses. Many Americans rely on imported raw materials to be competitive and for their components. Tariffs increase their costs. That makes us less globally able.
Words, I know, words. Now, here's the thing. I think, that reducing trade deficits is really important. And tariffs discourage imports, potentially narrowing the trade deficit. Somebody shouldn't be calling me right now. Narrowing the trade deficit by promoting domestic production and reducing reliance on foreign goods.
I don't think you believe that. Supply chain disruptions. Global supply chains are complex. Tariffs disrupt them and their networks, causing delays, inefficiencies, and forcing companies to spend even more money on alternative resources.
Question. I've got a question. Who wants a strong national security? All right, look, no. That was like 118, I just counted. So here's the deal. Tariffs can strengthen national security, protecting key industries like steel, semiconductors, and energy, ensuring that the U.S. not only is not overly dependent on foreign nations for critical materials.
What are those materials? It creates a weakened economic growth. Tariffs reduce trade and economic activity, leading to slower growth and potentially triggering a recession.
Everyone go, ooh. I know. That's pretty good. I mean, that was like a mic drop moment. You should have just stopped. However, I got you right here. How many of you like the idea of being taken advantage of? I don't. How about this? Let's encourage fair trade practices. Tariffs can be used as leverage against countries that engage in unfair trade practices, such as dumping goods below cost or using exploitive labor.
You know, tariffs create a burden on small businesses. Larger companies can sometimes absorb or pass on the cost, but small businesses like ours struggle with tariff-related increases, making it harder to compete.
Now listen, I want to support American jobs. By reducing competition from cheap imports, tariffs can help keep jobs in industries like manufacturing, steel, and textiles. Go American jobs.
You know, tariffs really create less consumer choice. When imports become more expensive, Americans have fewer options when they're shopping, and we all love Christmas. Limiting competition and innovation, and we want innovation in America. We're an innovative company.
C words, right? Yeah, I know. All right, now here's the deal. On the way here, I saw 13 potholes. I saw some roads that were just crazy damage. We've got bridges that are in disrepair, right? And I don't want to continue to pay higher and higher taxes. How about you guys? Okay? So, Randy, I'm going to land on this. Tariffs can boost government revenue. The government collects tariff revenue, which can be used for infrastructure, social programs, and offset other people's taxes.
I've seen your Jeep, and I think you're part of the pothole problem. Government revenue is at consumers' expense. While tariffs generate government revenue, they do so by taking money directly from American businesses and consumers. And in addition to that, geographical consequences, we create trade wars with tariffs and strain our diplomatic relationships, believe it or not, creating tension with our allies. We haven't seen any of that. And trading partners.
You know, Randy, as I look around this room, I see current and retired business owners in here. Okay, I care about U.S. business. I care about our business. Therefore, I'm going to say that tariffs encourage investment in U.S. businesses, and higher import costs push companies to invest in American workers, factories, and innovation rather than seeking cheaper labor abroad. Are you out? I have two more.
Okay, enough. You know, the impact of what a tariff or tariffs will do is somewhat unknown. And you can see that people can take either side of this. I think right now what we're seeing is a lot of negotiation using tariffs and the threat of tariffs. I don't know how this will all shake out, but the big objective that we have as a firm in the industry that we are in helping clients successfully navigate retirement is to find whatever we can do to optimize the outcome for our clients. And the rhetoric back and forth, the argument back and forth, it might be fun. And depending on where all we get our information, it can be very disturbing or exciting, or you might be pro-tariffs, against tariffs. The reality is, how many of you have any control of what the government does regarding tariffs? Please raise your hand. Okay, so if we can't manage that, what we can manage is how we play the game when changes occur. And I think that's what we have to focus on, is taking advantage of those opportunities that are created when things change in our economy, and when the rules change, we want to be informed and ready to act. That's the goal that we have to have, is to be nimble enough in our planning that we can make changes according to what actually happens, not what should happen, what people are projecting is going to happen.
Y'all can go home. Thanks for joining us. No, that was really, really well said. At the end of the day, I made kind of the joke, winners win, but the reality is, regardless of what's going on, if we're in a high tax environment or a low tax environment, if we're in an inflationary periods of time or stagflation, no matter what, how do you win? Because at the end of the day, like Randy said, we don't have control. They're going to act, they're going to do what they're doing, and Bill, they're not calling you. They ain't call me either, right? They ain't call you, Fred, did they? They ain't call me either, right? And I've got suggestions, okay? But the reality is, we just need to understand the rules to play the game. Is that fair? Okay.
Yes.
And by the way, I think I won. All right. 2024 was a strong year for investors. Now, it was interesting. We look back here and we follow that green line. As much as I like the green line, last year wasn't a straight green line, right? Look at all these dips, like dips, ducks, and dives that we took. And I remember, especially right in here, people were really, really concerned. We like to think in a straight line, like just naturally, but we know that the market's going to have ups and downs. And going back to about 1926, we know that approximately 2.7 out of every 10 years in the market, it's negative. Okay? You know what that's called? Normal. Normal. Now, do we like it? No. We just have to understand it. Is that fair? Now, 2024, again, being a really good year for investors, inflation moved closer to the Fed's target goal of 2%. Interest rates were cut 3 times in 2024, even though they said it was going to be 4 times. The economy was strong, and volatility has returned in the last few months, right? These are, just basic observations. Now, we can go ahead and start talking about inflation, because that impacts real people, right? That really does impact us, grocery store, cost of goods, services. While we can look at this chart and we can see that inflation has come down from its all-time high of 9% in recent times, that is, we still have to remember that 3% inflation we are experiencing today is still on top of the 9% we already experienced. It's not that things were 9% and now things are only 3% higher. They were 9% and now we're 3% higher. Y'all follow? Now, one of the big ways that the Federal Reserve tries to manipulate inflation is what? Interest rates. Well, I don't know about you guys. I've got 3 daughters and I've put them on seesaws and teeter-totters, right? And I think those are outlawed now. I don't even know if those exist. But here's how this thing works. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. Bonds have been really interesting to track and keep up with over the last 3 years. where we've historically looked at bonds for safety and earning a decent interest rate, that has not been the game of bonds in the last couple of years. As a matter of fact, many positions that we took for our safe money actually was in cash last year. Money market, if you've got money market paying about 5% and no risk, who wants to be signed up for that deal right now? Like, that's a good deal, right? So there were certain sectors of bonds that were more sensitive to what was happening in with the interest rate environment, and so we chose safety with cash, and I think that was a really excellent decision last year. All right, let's look at 2025 outlook. So we're going to continue to pay attention to inflation, interest rates, the new administration, and then, of course, what's going on around the world. It's interesting how much talk is happening around Ukraine and Russia right now. It'll be interesting to see how that plays out. Southeast Asia is still a problem. We're going to have to continue to pay attention to that, and then, of course, in the Middle East. So while we pray for our country, we pray for this world, you know, it's not lost on us that there is a lot going on out there. There's so much to try to pay attention to, so many moving pieces, but with this new administration, there could be some big influences that radically change some positions. Now, I want you to know that today, I am not biased one way or another. Like, do y'all remember the definition of politics? Poly is many and ticks are bloodsuckers. So that's kind of my view of that, all right? But the reality is, Republican or Democrat, there's always going to be changes. How do you win in either one of those environments? All right, here's a guessing game. This is almost like we could do a raffle on this. We should sell raffle tickets. Is the Federal Reserve going to cut rates or not? You know, who knows? Last year they said 4 times. They did it 3. They've said they're going to do it 2 times this year. Maybe they'll do it 1. They did not change rates in January. Who knows what's going to happen in their next meeting in March? We'll continue to pay attention because, again, this does impact inflation. This does impact how we position safe money with things like bonds. So I'm going to go ahead and welcome up Randy. I've asked Randy to come in and actually go over key indicators. Many of you wanted to dive a little deeper as to how do we measure the market? How do we what are some of the metrics that we use? And Randy's also going to do something unique because we do run some alternative investment models, and we selected one of those today just to bring everyone up to speed with what are current things going on within our firm and our portfolio. So Randy?
Hold on a minute. Don't leave me with a new remote. Which one moves forward? Okay. All right. Set me up to fail. So anyway, key indicators. So, you know, we use this concept in our office in how we manage money. We call it fact-based investing. And fact-based investing doesn't really pay any attention to the talking heads on TV that are telling us what's going to happen. A good example of Nick and I goofing around over tariffs. Because depending on who you listen to, you could really go down a rabbit hole and get very concerned or very excited about changes that are happening. The reality is that the changes that occur, they occur. And where we all live in a country in which we can vote, the reality is no matter how hard we try individually, we can't make a lot of change in terms of what's happening in the stock market, tax rates, etc. But if we know what's going on, then we can navigate, okay? And that's really what this is about. So fact-based investing isn't based on what Kramer's saying or some other guru on TV that's telling us what's going to occur, because the research shows with great confidence that those who make their living predicting the stock market and political outcomes are wrong 50% of the time. So, you know, if you have a favorite, and usually what will happen when it comes to that is somebody will be right twice in a row, and we'll begin to believe that they know something that the rest of the world doesn't know, and then when we follow their trend, we find out that we get our proverbial butt handed to us because they're not right the third time. So what we're going to talk about is a reality of what we look at in order to make changes. Okay, so we have basically 3 indicators that we look at. There's a 4th one that I'll talk about as we go into the model that we're going to discuss today. And one of them is a short-term indicator, and this is when it turned positive. So each of these have when they turned positive the last time, and this will make a little bit more sense as we go along. But basically, we've got a shorter term and a midterm and a longer term indicator. And so we kind of look at it like this. When one of those indicators goes negative or turns yellow, then it alerts us to pay attention to certain things happening within the economy. So right now, despite the volatility, and we're going to talk a little bit about that today, everything is still green. Now, it's not all the way to the right, but it is still leading us to believe that the emotions that might be stirred up into us when we hear that the Dow Jones is down 800 points. Well, that used to be a lot more than it is today, right? So, you know, when the Dow Jones was 3,000 or 6,000, it was down 800 points. That's a little different than where it is at 40,000, right? So let's go through that for a second. So here is what I'm going to suggest to you, something that we need to agree that we have to live with one way or another. That doesn't mean we don't do anything, but we want to do the right thing. So investing is counterintuitive. And that means if you have really good intuition, you're probably not a great investor. Because we have a way of living and surviving that's called fight or flight. So when we begin, and we're also designed as people to recognize patterns. And when you recognize patterns, you think you know what the next outcome is. So let's kind of visit that a little bit. So right now, what is the potential that we would have a correction, a 10 to 20% drop in the market? I'm going to suggest to you it's really high. It wouldn't be really high if we had a primarily Democratic House and Senate and President. It'd be really high if we have a Republican House, Senate, and President. This is what the market does. The market seems to be somewhat agnostic as to who's in office. So if I can get you to think like a real investor, and real investors understand that the market, the stock market and the economy works more like the seasons and think more like farmers than we might today. If we're a farmer, we recognize that we go through different seasons. So let's see how good we're doing. What is the next season you expect to have happen in your life? We're in winter right now. Spring. Who said spring? Are we, all right. So with what probability? Pretty high probability. When will the, well, if you live in Georgia, what you have is 17 degrees 2 weeks ago and 77 degrees today. So I don't know what season we're actually in. Because Georgia's not the best place to find that, or Dallas, Texas for that matter. But we think that we are past due. That doesn't mean we're predicting that the stock market's going to crash. And a lot of people who manage money like we do won't talk about the negative stuff. All they talk about is the positive stuff. So I'm going to tell you, if you take a long trip in your vehicle and you don't have AAA or a spare tire, then I think you're being a little bit foolish. So it's like, oh, it's just going to be great. No, you could have a problem. There could be, there could be traffic. There could be one of those potholes. We've got to prepare, and preparing is knowing that we have a plan and that we will do something if the market changes. And we're due for a change. It's probably, as Nick said, not long term, but it's not unusual for 2 to 3, or let's say 25 to 30% of the time for the market to be down. That's normal. So let's talk about this. This is the cyclical adjusted price to earnings ratio, and it's called the CAPE index. And this is an index that we look at. I want to just talk to you about where it is. This could be disturbing to some of you. Don't be disturbed, because we've seen this play out before. But the CAPE index looks at extremely high CAPE ratios, and it generally expects the market to eventually correct when it gets higher, and we're going to talk about what that looks like. In the past, when the CAPE ratio has Proven its importance in identifying bubbles in market corrections. So we're going to say that these are indicators. This is another indicator. It's not the ones that we were looking at earlier. This is a PE ratio, basically, or price earnings ratio. The historical average return for the S&P 500 index is between 15 and 16 for this CAPE index. That's the average. Well, the higher levels of the ratio have exceeded 30. These high levels have happened 3 times in history in the financial markets. So there's been 3 times that we've seen the market up at these kind of heights, okay? The first time was in 1929, then we had the second one in the 90s, and the third one in 2007. Does anybody remember any of these periods of time? Okay, so where are we? Well, this is 1880. How many of y'all remember that? Just one. All right. I'm kidding. Are you still getting Social Security? Some of you will get it, but anyway, so right now we're at 38.54 for the market. That's high, right? So if we look at, here's the average, here's where we are right now. And what this is suggesting is that when the CAPE index is between 30 and 40, the expected rate of return on the S&P 500 is minus 0.3. Now, again, a lot of people won't talk about this, but if you're a passive investor, and that means you put your money in, you close your eyes, and you never look at anything, then you'll just ride through all that volatility. As you know, and we'll talk about this in just a second, our portfolios are designed to take action when things like this are occurring. So we went back to those other indicators. So if our indicators start to show us turbulence in the market and weakness in the market, and I'll tell you how to think about weakness, then instead of being fully invested, we will begin to reduce or de-risk the portfolios. So we're not going to ride it out. And here's why we do it. Because part of what we manage is behavior. So what we don't want to have happen is things get really ugly, and at the worst time, because investing is counterintuitive, we get a call from a client that says, I can't sleep at night because I didn't bring a spare tire with me, right? And so we want you to know we have a spare tire. We have something, we know what we're going to do when things change. We don't know what's going to happen, but we know what we're going to do, okay? So we'll talk a little bit about how that works. So again, if we have that happening, this is what the stock market looks like going back to 1900. The green is when we've been in long-term bull markets, and the red is when we are in long-term bearish markets. So even though this is a bearish period that we're in right now, based on PE ratios, we're staying invested because the market has still been producing in this period of time, because our other indicators have not told us to go hide. Okay? So what we try to do then is not let our gut drive the decision making as to what to do with the portfolios, but to use indicators. And by the way, what you want is a combination. Like if you have a doctor that you see that you have a lot of confidence in, and you walk into their office and they said, you know, you look like you need a little heart surgery. I mean, no blood test, no x-ray, no MRI, you know, none of that. You just think that I need that? So you would want to make sure that anybody who's giving you advice has some way of monitoring these things and looking at them. And to us, those indicators are like taking the blood work and the lab work to make a decision, okay? All right, so.
Randy?
Yes.
Taking a look at that, at the combination of reds and greens, looking at that, summarizing it over the 124 years, especially that first period, it looks like overall, there is many long-term down periods as there have been long-term up periods. That takes a strong constitution to stay invested.
Right, right. So I think if you are, again, if we're looking at that, you know, when Nick showed the chart of last year and you saw all the volatility, but you saw the positive performance, the reality is that you can ride through some of this for quite a while. This is a big, long period of time. But if you'll notice, there are bull and bear periods within longer-term bearish markets. So that means if you have the ability to make modifications and adjustments, you can still make money in bear markets, but you can't just buy and hold it. Does that make sense? So that means that we want to have a strategy. Buy and hold works really well when you're in a long-term or cyclical bull market. So we're going to talk about a portfolio that will kind of bring some of that into play. And this is a portfolio that we have 3 portfolios that are a modification of what most people do. And this one is called MAD. And it's based on this concept of moving average distance. Moving average distance. So a moving average, we'll just take a look at this. Here's the formula. What is MAD, moving average distance? So in this particular example, a couple of days ago, February 19th, I took Amazon. How many of you have heard of Amazon? How many of you have a visitor bringing you Amazon on a fairly routine basis? Anybody besides me, right? You know, I order so much on Amazon that I forget what I ordered, and when I get a box, it's like Christmas. Because I can't remember what it was. But anyway, so here's an example of an opening for Amazon at $225.44. The average daily range was 223 to 226, 52. Week moving average 151 to 242. The 21-day moving average 234, 21, and then the 200 was 197. And then, who's good at math? Just make sure I did this right. Well, basically what they came out to is 1.19 by, the MAD takes the short-term average is 90% higher than the long-term average, potentially creating a bullish trend. Now, if you're in the MAD portfolio with us, we have 30 stocks, and Amazon isn't one of them, and I wanted to pick a stock that wasn't in there so you didn't get the wrong idea, okay? But basically what this is saying, that this could be a good potential position to be based on the MAD formula, where we monitor, and we could use this, by the way, with stocks, which we did here. In MAD, it's all stocks or all cash, okay? So in this particular case, if our indicators are positive, then we stay invested. In this particular case, we use another indicator, and I need to speed this up, but we use another indicator that has to do with the strength of T-bills versus equities. And when T-bills gain strength versus equities, we get another signal, and that signal we call BOSS, balance of strength signal. If that signal goes off, then we will go to cash with that portfolio. This means MAD, this alternative portfolio, is really only appropriate for most people if it's inside your IRA or inside a Roth, because there are more frequent trades. And if you have a really good run like we did last year, where I believe that portfolio did something like 50% last year. And if we had a profit like that and we got a bearish signal, then when we came out, which could be short term, it'd be treated as ordinary income. But inside an IRA, there's no tax consequences. Does that make sense? Yeah? Don't go to sleep on me, I'll go quick on it. All right, so the last thing we just talked, let me go back just 1 second. All right, so when we talk about this portfolio, this is an example of how indicators are used to make changes in a portfolio. But this works with funds, like ETFs or mutual funds as well, because in those cases, you can look at which of the ingredients, like large cap growth, large cap value, mid cap, small cap, which one are breaking away from their long-term moving average in the short term, And that might allow us in our portfolio to overweight those things that have a stronger moving average, and we can adjust the portfolio. So what's interesting about that portfolio, to give it perspective, because I don't want everybody getting excited and thinking they need to be in it. Because it's all equities, it is also not like an index because there's only 30 stocks at the maximum in it. And that means, like earlier this month, it was up about 14%. And now it's up about 4%. That's what happened to the market. Of course, the S&P was up about 4 and is down less than 2, I think, right now. So that happened to both, so there'll be more exaggerated returns and volatility in a portfolio that is less diversified than the index. Any questions on that? Okay, good. Was that boring enough? Was that? All right, so let's just talk about our economy. I'll bring Nick back up. So still the US has the largest economy in over 100 years. In 2025, it would exceed 30 trillion. 30 trillion, I can't even get I didn't know what that is. Like, that's ridiculous. You know, we throw billions around and trillions around like, you know, like it's change, you know. But China has the second up here at the top with 19.5 trillion. And then we can see what's kind of changes that are occurring. Germany overtook Japan in 2024, and it's expected that India will pass the UK. And I think you'll see, it doesn't mean we should trade on this, but India becoming stronger and stronger and stronger as they become more developed. And anyway, kind of interesting. All right, I'm going to bring Nick back up.
At the end of the day, we were trying to appeal, make sure somebody leaves here. Everybody should leave here with something. That's our intent, right? It's for some folks, the word tax up here, you just really got excited. Some of you got really, really nauseous, okay? So, I mean, at the end of the day, we're hitting a lot of material today, but again, our intent is that everybody leaves with something of value. Is that okay?
Yes.
Is that okay? All right, so one of the first things I learned in this industry, so I got in this industry 23 years ago, okay? And one of the first things Randy taught me when I got in was the easiest and safest way to increase the return on someone's money is to cut their tax bill. Has nothing to do with the stock market, has nothing to do with bonds, has nothing to do with this. It is, are you keeping more money in your pocket, right? So one of the things that, you know, we're going to talk about today is like where are taxes right now and what can we do forward looking. A lot of people, when I first meet them, I say, you know, do you have a tax plan? Literally, I bet you 8 out of 10 times they say, well, I have a CPA or I have TurboTax. Okay? That's not a plan. What that is your method of filing your taxes. Okay? And that's good. You should have a really good, competent tax filer, or you should be able to use something like TurboTax, etc. if you do it yourself. That's good. There's nothing wrong with that. But that's not a plan, that's filing. We want 3 to 5 years forward looking, how do we reduce your taxes? Right? And, you know, there's a lot of things, you know, that we're considering, you know, especially with the deficit. I mean, there's only been 4 times in U.S. tax history that taxes have been as low as they are right now. And this is so elementary and so dumb. Follow with me. What goes down must go. What? Further down. I'm voting for you. Whoever said that. All right. So here's the 2025 tax brackets if you haven't seen this yet. So it has been updated. So the first, you know, if you're married filing jointly, let's use that one. 0 to 23,850. That first 23,000 is taxed at 10%. Then 23,851 to 96,950. That part of your income is taxed at 12%. And then here at 22% and so on. A lot of people think that if I'm in a particular tax rate, it's based on my total income. So I'll have people say, well, Nick, I'm in the 32% tax bracket. Now, what they mean to say is that their highest bracket is 32%, but not all of their income is taxed at 32%. So if you're taking notes today, one of the most important things that you can find out for yourself if you don't know it is answering this question. What is your effective tax rate? What is your effective tax rate? Your effective tax rate is the blend of all your tax rates together across all of your income. So as an example, if I'm in a 32% tax bracket, my effective tax rate might be 23% across all of my income. Does that make sense? So it's one of the most important things you can find out. So as you're gathering all of your stuff for tax season and you're going to meet with your CPA, ask them, what is my effective tax rate? Long-term capital gains taxes. You know, I'll never forget, this is about 2 years ago. We had a client that was just paralyzed. I mean, they could not make a decision on a particular piece of their portfolio because it had such low cost basis. But they really wanted to sell it, but they didn't want to pay the what? The capital gains taxes. We said, hey, has any financial advisor or financial professional ever reviewed your tax returns? And the answer was what? No. Why would they? They just invest. Well, that's kind of like a doctor giving you medicine without doing any diagnostics. So we reviewed the tax returns and we said, great news. Great news? You just read my tax return and you're going to say great news? Yes. You can sell that part of the portfolio that you're so nervous and scared about, and you're going to pay 0 taxes to do it. Well, aren't capital gains rates 20%? Well, they're 20% if your income is here, but your income married filing jointly is less than $85,000 this year. They retired early in the year. They didn't have much income for the rest of the year. They were able to sell that security and pay 0 taxes. What you don't know can hurt you. What you don't know can hurt you. Annual exclusion. So if you are doing any gifting this year, the new number for gifting is $19,000 that you can give to anyone you want, and there's no gift taxes. Okay? So some ideas that we've included here, how about contributing to a working child or grandchild's IRA? You know, where you help them fund their Roth IRA, right? We've seen a lot of clients where they'll help fund a child or grandchild's IRA, Roth IRA, which then that child or grandchild can contribute more to their 401k. So that's really, if you are thinking about gifting, that's a great idea. And then also gifting to a 529 plan. 529 plans used to just be called the college savings plan. So they came out of the same legislation that the Roth IRAs did. That was the Taxpayer Relief Act of 1997. Okay, so back then it was just a college tuition plan or for trade school. Today it can be used for so many things, and even if you've heard one of our podcasts, it can be rolled over now also into a Roth IRA. There's a lot of rules around that, but it's become a really powerful tool. All right, sunset. This is kind of a weird slide. It just looks weird, doesn't it? Sunsetting tax laws from the Tax Cuts and Jobs Act in 2025. At the end of this year, our current tax rates, everything sunsets, and a lot of folks say, well, because Trump's in office, he's not going to let that happen, blah, blah, blah. Well, here's the reality. The president, regardless of who it is, they don't get that say-so. Who makes that decision? Congress, okay? So Congress could extend provisions of the Tax Cuts and Jobs Act. They could revise it. A lot of what I've seen so far in terms of proposals and projections are quite positive to most of our clients. So we'll continue to monitor that. But again, there's always promises, but then when the rubber meets the road and you actually see what happened, that's when you find out if this is a good thing or a bad thing for you, Okay, so we're going to watch that. R&Ds have changed. Required minimum distributions have moved from age 72 to age 73. It's going to stay that way until the year 2032, where the new required minimum distribution age will go to age 75. So when we do think about an increase in taxation for a lot of people in retirement, they've accumulated most of their wealth in what? Retirement accounts that have never been taxed. Then the government forces you to take it out through a required distribution, regardless if you need it or not, and I call that forced taxation. Roth IRA, so if you've been around us for any length of time, you know we're fans. We love the Roth. You know, there's a story about my great uncle Jack, who just he passed away about a year ago, lived to the ripe old age of 101. Okay, he was a farmer in Canada. Okay, and he ate every day for breakfast the meal the FDA said would kill you, right? Bacon, eggs, you know, and he was a gigantic man in that. But here's the deal. You know, my dad used to spend some summers at his farm, and, you know, you work on a farm, right? That's work, okay? You learn a lot also about planting and harvesting, sowing and reaping. And here's the question I often ask people. Would you rather pay tax on the seed or the whole crop? Seed. What do we do with our 401ks and IRAs? We get the tax benefit up front and we end up paying taxes on the whole crop, don't we? Because we were told a long time ago that goodness and mercy would follow us all the days of our life in retirement. You'd be in lower tax rates. What we've learned is most of our clients are in the same or higher tax rates. They lost deductions and write-offs and all kinds of stuff, and they're retiring into the same or higher rates. We got to be mindful of that, but one of the things that sometimes it's a misnomer that people have is just because you're retired doesn't mean you can't have a Roth. You can have a Roth. Many times you can have a Roth. It's just the mechanism to get the money there, and that's where we can help. Everybody say this with me. Tax. Free. You now know two of my favorite words. All right. All right, the donor advised fund, I'm not going to spend a whole lot of time on this. We've sent out some different articles and things like that we've discussed this in the past. So donor advised funds is a great mechanism of bunching multiple years of charitable giving in 1 year. So if I'm going to give, you know, over the course of 5 years, you know, $10,000 a year, that's $50,000. I could give $50,000 into my donor advised fund, get a tax deduction, and then have my donor advised fund make 5 years worth of gifts to the, you know, church charity organizations I care about. Why would you do that, Nick? Because I get 5 years of deductions that could help me do what? A really big Roth conversion and pay little to no taxes. Okay? So this is a really great strategy, especially if you're charitably inclined. QCDs. So those of you who are approaching age 70 and a half or are 70 and a half and older today, one of the things you're allowed to do is give a distribution straight from your retirement account to those organizations you care about. Now, why would somebody do this? Because when you do this, it's better than getting a deduction. You pay zero taxes for that money to come out of your IRA or 401k to go to the organization you care about, and it does not count as ordinary income on your tax return. It won't push you into higher rates. It is literally having your cake and eating it too. I can't believe that they allow this, just to be honest with you. I thought they were going to sunset this about 4 or 5 years ago, and when they extended it, I was really surprised. Like, it's that good of a thing. So we know that taxes are going to continue to change. If you don't have a tax plan, maybe make 2025 the year that you get one, so you know where you're headed. You know the direction you're going. And then you'll pivot as you need to pivot. because again, the government's going to continue to change the rules. So we do appreciate you. Last year, we had our best year of business ever. And many of you made introductions to us, and thank you so much. I mean, that's not lost on us that you've done that, and we just feel just really, really appreciative of everybody. This is a big year for us. This is our 30th year in practice. Our company 30th anniversary this year. So we want to make this a staple year. If you do know someone who could, maybe use a second pay or just wants to have a cup of coffee, we always appreciate an introduction. With that said, one of the things that we have really enjoyed doing over 2024 is we kicked off our podcast. Who is listening to our podcast or watching on YouTube right now? Okay, all right. All right. I even got some handshakes. Listen. I'm living out, I shared earlier that, when I first went to college, many of you might not know this, I actually wanted to be a DJ on the radio, all right? That was my dream, all right? And then I got to college for broadcast journalism, and I found out those guys live really hard lives. I'm like, I'm out, nope. So the podcast, I'm kind of like reliving this dream I had, so many years ago, and we're having such a great time. But this is also a great way for us to get up-to-date information to you. We're releasing one every other week, and we just did one that got massive views and a lot of feedback, and that was the recent update on Social Security that just happened. Okay, so there's a lot of movement in Social Security right now. Right before President Biden left office, he signed a new Social Security Fairness Act, and that impacted if you have a government pension, if you fell under windfall elimination provision. I mean, we're talking big changes for those people that were impacted by those things. So the podcast is an easy way for us to constantly get relevant information out to you. So if you don't mind, I want to ask you to do me a favor. If you're not subscribed, this is a QR code, also AKA a box with squiggly lines, as I've heard some of you call it, all right? You get your camera out. If you need help, somebody can help you. Point it here. A box should come up. You can press it right there. It'll take you to the YouTube page where you can see the video or you can listen on audio. With that said, one of the best parts of the podcast, I've heard you, Aaron Calhoun, okay? He is one of the best. He's our faithful host of the podcast, and what a gift he has as he kind of allows Randy and I to have some banter back and forth and enjoy that time. So I'm going to turn it over to Aaron here in just a second. Last year we were featured Cobb in Focus, had a great time with that. I was stopped in the grocery store one time. That was kind of cool. I was like, and then we have our fun disclosures. So from all of us, thanks for being here today.